and welcome to this HYPE event. So for those of you that don't know the clusters, the History and Political Economy of Business and Finance Research Cluster is based in the Open University Business School and brings together scholars who aim at developing a critical approach to business and financial theory. So HYPE puts forward an interdisciplinary research agenda using insight from the perspective of political economy and history. And today's event aims at providing an alternative angle to the discussion about household debts in the UK. So we will have insight from a more applied experience that can be invaluable to informing academic research and in sustaining its societal impact. So we are very happy and delighted to have with us today Jo Cox, which is a senior policy officer working on personal debt issues for the campaigning organization Debt Justice. And Jo has been a campaigner, political officer, and researcher for over a decade, and he has been working on issues related to inequality and collective power building. So Jo's presentation is titled From Despair to Where, a short history of the UK household debt crisis. So thanks a lot again, Jo, for your time. The floor is yours. You will have 45 minutes for your presentation, and then we will open the floor for discussion. Thank you very much.
Thank you. It's really wonderful to be here. I mean, I try to be critical and interdisciplinary in terms of what we, what I do, what we do. Perhaps you can tell me at the end whether I hit that brief. But yeah, it's really fantastic to be here. I'm going to try and make sure I'm sharing the right thing, which I think I am. Is that okay?
Yes, we can see.
Wonderful. Thank you. So, at the end of this, I hope you've got, you'll have a better overview of some of the issues that we're grappling with as a charity, some of the issues that policymakers are grappling with, economists, social justice campaigners, everyone working, debt advisors, everyone working on the challenge of the UK household debt crisis. I'll get into why we call it a crisis, why we conceptualize it as a crisis throughout the presentation, and maybe at the end you can tell me whether you agree with that as a hypothesis. The title From Despair to Where is a Manic Street Preachers song. It just popped into my head when when I was asked, what do you want to call it? But so there we go. There's nothing much more than that. But I mean, I suppose there is slightly more in that. I hope the where is, is a much better future than the one that we've had, at least over the last decade or so. When it comes to debt, household income, and living standards and stability for UK households. So I'll start with a summary of the current picture, and I think it's fair to say that households remain highly burdened by debt as we navigate another cost of living crisis. In all our communications, we tend to call this latest cost of living crisis another cost of living crisis. I was saying earlier that I graduated in 2008, so I feel like it's been one crisis after another, and millions of UK households, I'm sure, would agree with me. So this first graph shows secured and unsecured debt as a percentage of household disposable income. Now, this is a pretty good measure of the sustainability of debt for UK households, and disposable income is income after direct taxation. And when we talk about secured debt, we're mainly talking about mortgage finance. There are other types of secured debt, but mainly we're talking about mortgage finance. And unsecured debt, we're talking about consumer credit, loans, credit cards, overdrafts, vehicle finance, insurance by instalments, and buy now, pay later are typical consumer credit products, which we're talking about. So you'll see a reduction in this measure after the 2008 crash. and a bit of a stabilization and uptick from 2016. The peak came in Q4 2008 at 155%. Ish, declined to about 132 by late 2015, and then rose again to 136% by mid 2017. The last available statistics, Q3 22, it was around 134%. So how does this compare internationally? So the UK is in sort of the top quarter of the league when it comes to the overall indebtedness of households. You know, when compared with disposable incomes, it's higher than Italy, United States, Germany, Japan, France. It's slightly lower than Canada, it's lower than Korea, it's lower than some of the Nordics, but it's high by international comparisons. You know, there's other reasons to believe that the Nordic countries have a more kind of sustainable debt picture, in spite of that ratio being higher because of various things around their social security system predominantly, but we'll get into that a bit more as we go on. So in many ways, we could be seeing record high unsecured debt levels in the UK by many measures. So if you include student loans, unsecured debt levels were increasing to record highs before the pandemic hit and have remained at similar levels over the past couple of years. The most useful measure here is unsecured debt as a percentage of disposable income. That's the yellow line rather than the overall stock of debt. And historically, 25% was seen as a measure of high debt or over indebtedness, and so that's where we are on average now. If you include student loans, now there's a lot of discussion about whether student loans should be used in this measure, but I think, you know, it is a true reflection of the amount of disposable income people have, you know, once that direct taxation and is taken out. So just for a bit of context, we tend to focus on unsecured debt, debt justice, and there's a couple of reasons for that. Unsecured debt is what people struggling to make ends meet are more, you know, they more readily rely on. So for us, other social justice organisations, charities will often see that as a more pressing social justice issue, the reliance on unsecured credit and the vulnerability that unsecured credit comes with. Secured debt, of course, is mainly mortgage payments. So people on higher incomes, people in a relatively better off position, can be highly leveraged with mortgage payments and mortgage debt, but still be building up their financial position and still be building up their asset holdings. So, you know, we tend to focus on unsecured debt levels for those reasons. Now, I think it was often said in media framing during the pandemic that households cut expenses and built up savings. There was lots of talk as we come out of the pandemic about a savings glut. What are all these, you know, well-off households in the UK? What are they going to spend their money on? But I think importantly, this graph shows that the luxury of paying down debt during the pandemic was afforded to higher income households. You know, the number of UK millionaires also increased by a fifth during the pandemic. Lower income households often incurred higher costs. They had to forego earnings. They often had more pressing childcare issues, lower sick pay. They were more likely to be made redundant. And as a result, they were more likely to have to borrow to make ends meet. And this graph basically shows that households with a household income above £35,000 come out of the other side of the pandemic with a more healthy household balance sheet. Those with a household income below £35,000 ended up more reliant on credit and run down their savings as we exited the pandemic. So given that there's been a relative stability in overall debt levels, unsecured and secured debt over the last few years, why do we call it a crisis? So I think the reason predominantly is that aggregate figures can only tell you so much. You know, the UK economy is highly unequal. There are huge income and wealth imbalances, and they intersect along class, gender, and racial lines. And these headline statistics, these headline measures, these aggregate figures all take place within this grounded and lived reality. You know, we have 13.4 million people living in poverty, and that's a government statistic from the Department of Work and Pensions. Now, this is households below this is the household below average income measure, so 60% below median income equivalized, so adjusted for the size of the household, means that people are classed as living in poverty. We have around 25 million people that have characteristics of financial vulnerability. Now, the financial regulator, the FCA, calculate this statistic, and they include people that have low financial confidence, they have health issues, they've had big life events like bereavement and job loss, which means that when they go out into the world and engage in financial services, they are in a vulnerable position. I always find this statistic completely staggering because it's around half of the UK adults. So, you know, if half of the UK population are vulnerable to you know, the products and services being offered by the financial services industry, then I think that shows a quite deep systemic problem. About 9.6 million are over indebted. Now, by over indebted, we mean people that have missed paying bills for free of the last 6 months, and or they are finding their debts a heavy financial burden. So that means that, you know, there's a kind of qualitative and quantitative kind of measure there to over indebtedness. You know, it's a feeling, it's a heavy burden, but it's also measured in terms of missed payments. We've got another 5.5 or so million people who are economically insecure and could be easily pushed into heavy debt. Now, this is sometimes known as the measure of low financial resilience. It basically means that 5.4 million people could not afford a £50 drop in their income, or they couldn't withstand going without their main source of income for 1 week. There's 3 worrying trends which we're seeing recently as well. Of course, I'm sure this has been much spoken about. It's in your classes. I mean, it has in the public debate, and that is rising inflation. You know, inflation has now been consistently running higher, a much higher level than wages and benefits for at least 12 months, 18 months. You know, this is leading to push people to borrow for essentials. So the increasing borrowing we see, particularly on credit cards. Credit card borrowing is increasing at rates not seen since 2004. We also, partly because of the rise of interest rates and the increasing cost of finance, that you know, the cost of that borrowing is going up as well. So mortgage borrowing rates, obviously, that's had perhaps a more, or perhaps even disproportionate amount of media coverage, but they have tripled in a year. You know, that is significant. Credit card borrowing costs are up, highest since '98, etc., etc. So we've got that going on in the background. So this graph is from the Bank of England Financial Stability Report from last December. It's reasonably confusing, but just, you know, pay attention to the graph on the left. Now, what this is measuring is the cost of living adjusted mortgage debt service ratios, which come in at over 70%. So in other words, this is highly indebted households that are most at risk for mortgage default. That's what it is. That's what this is measuring. You you'll see that the great financial crisis peak was around 2.8%. Well, the Bank of England predicts that next year will hit about 2.4%. So worryingly high, I think we could say. But really, these measures, these aggregate figures, these more targeted distilled figures, these are just one part of the picture. What it means in reality is, we've got huge numbers of people in the country that are feeling anxious, depressed, or filled with dread, or unable to cope due to their finances. This has severe mental health impacts. We have around 400,000 people with heavy debt consider suicide every year in England, and 100,000 people every year in England attempt suicide. It's fundamentally, for us as Debt Justice, we see it as a huge injustice that those that have money to lend profit from those that need to borrow to make ends meet. And we now have around 15 million people in the country that are using credit to pay for essentials, or being forced to use credit to pay for essentials. So for us, that's why it's a serious social justice issue. So how did we get here? I promised a short history. Well, this is, a reasonably short history, but I think it's worth going back a bit further than the snapshot that we've already looked at, to look at some of the driving factors, the long-term drivers as to why UK households are so exposed to high inflation, why they are so exposed to the pandemic, why they are so exposed to borrowing and problem debt. Well, why is that? I think we've tried to pick out a few of these drivers here. So we've got 5 that I'm just going to talk about. One is rising inequality and the falling wage share. Second is insecure work. The third, financial deregulation. The fourth, inadequate social security. And the last one is around technology, culture, and advertising. Now, I put this one last. I think it's less important. I'm a materialist, so but I think that I wanted to put something cultural in as well. So you've got that one. So rising inequality. So income inequality in the UK exploded in the 1980s. One of the main measures of inequality is the Gini coefficient. It's now around 60% higher than average levels throughout the late 1970s and 1980s. So the Gini coefficient is a measure of the overall extent of which groupings of households from the bottom of the income distribution upwards receive less than equal share of income. The higher the coefficient, the higher the levels of inequality, which you can see reflected in this graph. It's got a couple of, 3 other inequality measures as well, but they tend to suggest the same thing. Broad stability over the last 10 years in terms of inequality measures, with the big increase in inequality occurring throughout the 80s. And why is that? Well, fundamentally, a large reason is because of the falling labour share of income. So in 1975, workers took home around 72% of the value of national output in wages, and now the figure is around 60%. Now, in a sentence, you could say that really capital is winning at the expense of workers. That's a one-line takeaway that you can take, I think, from those 2 graphs. Social security. Now, why is inadequate and low social security such a problem when it comes to household debt and vulnerability to household debt? Well, in the UK, the financial stability of households is highly dependent on wage labour. When UK workers lose their jobs, they experience a large drop in earnings, making them extremely vulnerable to unsustainable debt and borrowing. This is a TUC analysis of replacement rates compared with OECD averages. So what it basically shows is that if you lose your job, how much of that lost income is likely to be or will be replaced by social security benefits. Well, if you're single and you have no children in this country and you lose your job, you're going to lose the vast majority of your income. Only about 13% of it is replaced by out of work benefits. So, you know, the drop in income as a result of losing paid employment in this country is absolutely huge. It's larger than the OECD average. There was one poll survey by the TUC during the pandemic, which showed that around 50% of people that lost their jobs ended up in heavy debt. You know, within a matter of months, people were pushed quite heavily into debt. So insecure work. So gig work, the rise of gig work, which is often or is insecure and low paid, often with no guaranteed minimum income or hours, and inadequate sick pay, has grown quickly over the last 10 or so years, particularly between 2015 up till today. So you'll see the amount of gig work, or the amount of UK workers engaged in gig work, has gone from around 1.5 million in 2016 up to 4.5 million in 2022. Financial deregulation. So I think let's go back to the 1980s here. You know, the deregulation of the City of London of financial services, the demutualisation of lenders, the breaking down of banking firewalls between retail and investment, the lowering of bank lending ratios, rising asset prices, the gluts of capital, all of that really turbocharged the amount of credit that could be loaned out to UK households, you know, that could be laundered through the City of London and then packaged into financial products and lent to households. You know, this is when we saw the creation of things like credit cards. And of course, once finance has this spare capital and they're allowed to create new products, they will certainly do that. And of course, you know, we can trace this back to the Big Bang in the city. Lastly, on the long-term factors which have driven the crisis, just something on technology, culture, and advertising. You know, I think this is, like I say, I think this is less important than the political economy that sits beneath it, but I think it's worth mentioning too. Because technology can reduce the friction that's involved in borrowing, and targeted marketing also becomes easier. So you get a kind of interplay between advertising, retail, media, and lifestyle brands, which apply more intrusive pressure on borrowers and encourage consumption. So if we're going to take the long view, or the slightly longer view on the UK household debt crisis, I think we do have to go back to the 70s and the 80s. I think we have to go back to the Thatcher revolution, because obviously in the 1970s there was a kind of profit and stagflation crisis. This was a global phenomena, but it was particularly keenly felt by policymakers in the UK, who saw this as a particular problem which needed fixing. And the way that this was dealt with by the Thatcher government and her allies in the Bank of England and other places was through the weakening of labour protections and the breaking of union power, the Big Bang in the city. You know, that was as a result of the stagflation and what they saw as a profit crisis. You know, the labour share of value was eating into that headline profit. They didn't like it. You know, that's what spurred the Thatcher revolution. But of course, what this did was displaced or put off slightly that crisis and kind of transformed it into a slightly different crisis, which came along, a decade or so later, which was a wages and demand crisis. Because as soon as workers are taking home less of the national the national wealth in terms of wages, then the less they can spend, which means that it creates a bit of a demand crisis and a wages crisis. And that's really a second spur as to why the deregulation and extra credit was used as a bit of a fix in the late 90s and the 2000s. This is a phenomenon at the time known as privatized or private Keynesianism, where extra borrowing, unsecured borrowing was strongly encouraged among UK households as a way to spur economic growth. They didn't want to raise wages in real terms significantly. They didn't want to raise Social Security in real terms by any serious amount. So they used credit and finance to bridge that gap. Now, ultimately that's run out of steam, and I think that's where we are now. So if we were to tackle this crisis, which I hope we are able to do, I think the things you have to think about are three things. Clearing the build-up of unsustainable debt, you need to fix regulation, and you need to tackle these structural underlying causes. Now, the types of debts that you would need to confront if you were seriously to confront this issue would include consumer debt, energy debt, debt owed to central government, council tax debt, and of course, mortgage debt. So, we at Debt Justice advocate for a fair debt write-down, which would reduce the debt burden for thousands or hundreds of thousands of people whose consumer debt has already been devalued on secondary markets. So there is a whole market of debt purchasers and debt collectors, which will buy devalued debt from originating lenders. They will seek to collect that debt at the original asking price, and they will benefit from collecting the full amount of that devalued debt. Now, we think that the government should intervene in that market. It should buy up these devalued debts, and it should therefore devalue the repayments and give some relief to people paying back those debts through debt management plans, predominantly. Energy debt, there's now £2.5 billion worth of energy debt. The government's support package on energy was pretty significant fiscally, but we still have around £2.5 billion worth of energy debt. So this is the number one issue that people are going to citizens' advice for at the moment. Energy debt is, of course, a massive issue. About £2 billion of that is completely unsustainable. It will be written down eventually. The government should, we believe, get hold of that. Debt owed to central government can be things like historic debt, such as working tax credit overpayments. We think that those which are as a result of government error should be completely written off. And any deductions from Social Security should be subject to individual affordability assessments, because at the moment what Social Security deductions are doing is pushing people further into debt and poverty. Council tax debt is another huge issue in this country. Again, that's around £5 billion or so in England. The way that this debt is collected is particularly pernicious. Local authorities are underfunded, so this is one of the only ways that they can, or they feel that they can recoup some money, which leads to some quite heavy-handed enforcement practices by local authorities. Mortgage debt. Now, about 1.6 trillion of the 1.8 trillion pounds of overall debt is mortgage debt. If you were seriously going to look to tackle the debt crisis, you would have to look at that mortgage debt and the housing bubble and let some of that steam out. You know, one way that people have conceived of this is to broadly allow housing values to stagnate, to increase council tax, to increase council building of homes, and to eventually let out a lot of that steam and devalue that mortgage debt pile in real terms. You know, if workers are getting maybe 5-6% nominal pay rises and house prices stagnate for a decade, then of course that means that that overall stock of debt gets slightly inflated away. I think we probably need to take further steps than that, and we need a big, bold intervention. I'd be interested to hear if people have ideas about how we let out some of that steam from the mortgage debt bubble and really to bring down housing prices in a way that is, you know, is sustainable. Fixing regulations. I think there's just 4 things here that I'll highlight. One is that you know, borrowers need further protection. Buy now, pay later is still not regulated. You know, the FCA doesn't have the power to regulate that. You know, debt packager fees for IVAs. So these are nominally debt solutions, which insolvency practitioners and companies push on to people with unsustainable debt. You know, they get large fees from these. People need better protection from that. Capping the cost of credit card borrowing in particular. So lots of credit is now capped at 100% overall fee. So you know, if you borrow now, if you take out a payday loan, for example, if you take out £100, you should only ever legally pay back £200 at most. Now, of course, 100% you know, interest and fees is still very, very high. But you know, there used to be no upper limit on the cost of borrowing. So the cap on the cost of credit doesn't apply to all credit products. Saying, you know, we need to push that into credit cards. You know, we need to enforce this stuff properly. And importantly, we need to do a lot on insolvency as well. So the personal insolvency landscape is outdated, it's inflexible, it's costly, it's confusing. Quite often people that need help with personal insolvency options don't get the right advice. You know, the government's looking into this at the moment, so we'll see what comes out of that. And access to affordable credit. You know, I kind of think of credit as rather like technology, in that it's neither simply good or simply bad, or, you know, it's a lot more complicated than that. And affordable credit, timely affordable credit, can be really useful in bridging the gaps between, you know, bridging the gaps between income and outgoings for households. But ultimately, you know, none of this stuff is going to be tackled unless the underlying drivers, some of the underlying drivers that I talked about earlier, are confronted head on. So that means tackling low and stagnant pay, collective bargaining needs to be extended, trade union rights restored, so that workers can secure a higher share of that wealth they create. Insecure income needs to be tackled through stronger employment rights, and Social Security needs to be set at a level which means that when people lose their jobs, they are not pushed into borrowing and high cost credit just to survive. So I'm just going to finish on this, which is to say that, you know, how do we win these changes? How do we as Debt Justice think that we're going to get close to tackling the household debt crisis, given that it's so intermingled with many other things, and there's huge vested interests involved in ensuring that the system kind of broadly stays the same, because it sure does benefit a small amount of lenders, collectors, purchasers, and enforcers. So how do we win the changes, given that it can seem like a David and Goliath battle at times? I mean, firstly, what we're trying to do is build an informed, confident, and powerful UK debtors movement. So the United States has a much more advanced debtors movement. It's particularly pronounced around student finance and student fees in the United States. But the consciousness of debt and the role it plays in extracting wealth from us, from the households, and redistributing wealth upwards, that consciousness, I think, is a lot further ahead in the US. We need to go out there, we need to make that argument, and we need to build solidarity between people that are in debt, have experienced debt, or are at risk from debt. Secondly, we need to really connect with the other struggles for economic justice. There is no solving the household debt crisis without solving things like the race pay gap, without proper social security, without proper regulation of finance. This is a structural economic issue which drives people to borrowing. It needs structural economic solutions, and we're only going to win those working in solidarity with other social justice organisations. And thirdly, for us, what we try to do is pursue an insider and outsider strategy. So, it's all very well getting invited to meetings with the Treasury or with the business department, and we're always up for those meetings. But yeah, I think what you have to do as a successful, if you are to be a successful change maker, some people that make structural economic and political change, is that you need to have a source of power with which to wield while you're having those conversations. And we're not quite there yet, but that's what we're trying to build. I hope that spurred some interesting thoughts, reflections. It'd be great to hear challenges, questions, anything that spurred. So this is my email. This is my Twitter handle if there's something that you'd like to follow up on. But I have spoken for more than long enough, so I will leave it there. Thank you so much.